Right, looking at asset disposal, this is when a fixed asset has been removed from the books. So when you remove a fixed asset from your books, right, either by a form of a sale or by way of exchanging for another, and that is considered as a disposal. This is when that particular asset can be any one of the fixed or tangible assets that can be disposed of. That means basically sold. The asset can be sold for cash or credit. Yeah, those are the two forms of sale of an asset. So you're gonna sell your asset for cash, or for credit, or the asset can be dealt through what you call a trade-in. So when you trade in the asset for another asset, right, the trade-in value, right, will be the selling price. So the trading value will be the selling price. So you can sell an asset for cash or for credit. That means the selling price is easily determined. But on this one, if the asset is traded in, right, the trading value is the selling price. Right, there are instances as well whereby the asset is completely destroyed. Let's say maybe it's a vehicle, or it's a building, or it's an equipment that was destroyed either by accident. If vehicle was involved in an accident, the building was burned down, by fire. So when you're talking about disposing of in those kind of situation, most of those things are insured. So when you get the compensation from the insurance, that will be treated as the selling price of that particular asset. And mostly insurance, they tend to kind of like restore the same. And then depreciation for this asset is calculated to date of sale. So if you sell the depreciation at the beginning of the year, it's easy. If you sell it at the end of the year, it's quite simple, because you calculate depreciation for full year at the end of the year. But at the beginning of the year, that means there's no depreciation, because the current depreciation is on the first day of the year. There's no current depreciation, right? So it becomes a bit easier. The cost price and the accumulated depreciation. So the cost price and the accumulated depreciation of the asset disposed will be removed from the books. So that will be the accumulated depreciation up to date of sale. These need to be removed from the asset books, right, of the business. Then accounting for disposal. Accounting for disposal, it's quite simple. There are three accounts involved, right? There is the asset account that you need to remove the asset from. Then you have the accumulated depreciation. Then disposal account, whereby you need to remove the asset from those particular assets, right? So if I have to draw just simple T accounts, I've got the asset account, right? Then I've got the accumulated depreciation account, then I have the disposal account. So what you do is, when you're disposing of an asset, right, you're going to debit your asset account, right? Let's say it's vehicle, right? You're going to debit your disposal, right? And then you have the amount here. Then you go to your disposal account, right? You're going to create the asset account with disposal, and go to your disposal account, and let me just change the color of the pen. This looks a little bit brighter, right? Then you go to your disposal account. You debit your disposal account with the asset, right? Then that will be the way you remove the asset, the cost price of the asset from the asset account. Then for depreciation, And remember, you'll have accumulated depreciation. That means balance PD for that particular asset. You have balance PD. So what you do is you basically debit, right, your accumulated depreciation with disposal. Right, and credit disposal account, right, with accum dip. Right, that will be the double entry for that. Right, then for these accounts, they will have closed. Remember, here I'll be having balance brought down. Let's say it's the only asset that I have. That means I'll close off this account. Let's say it's the only, that's the accumulated depreciation for the asset. Now is the only vehicle that I had. Let's say it's a vehicle. That means I'm removing the vehicle from the depreciation from the particular account. But you find most of the times you have a number of vehicles, so it doesn't necessarily close down, provided that you're not required to calculate depreciation for the current year, or you're given accumulated depreciation at the beginning of the year, but you still need to calculate depreciation during the year. So you will need to do some depreciation calculation for current year, then for T accounts, but generally you just work it the way it is. So these will close. Then for asset disposal, for disposal account, right, you leave the selling price here, you leave sales, then the amount, right. So those are the two things that go in there. So on the credit side of the disposal account, you'll have accumulated depreciation of the respective asset and selling price of the respective asset. Then you balance it off. So what happens is if the debit side of the disposal account is smaller than the credit side, this will be profit. Right, that will be profit. But if the credit side is greater than the debit side, right? If the debit side, right, is greater, is less than the credit side, is profit. But if the debit side is greater than the credit side, that will be a loss. And to be simple, I will just write it down. So what we're saying here is if the debit side is less than the credit side, it's profit on sale. That means the accumulated depreciation implies the selling price is more than the cost price of the asset, right? But if the debit side is greater than the credit side, that will be a loss on sale. In simple terms, what we're saying here is, let's say the asset was bought for 40,000 and accumulated depreciation, right, that's the cost. Then accum dip is 35,000, right. Then selling price is 6,000. So what we're saying is these two sides, the 35 plus the 6,000, they're more than 40,000, so that will be a profit. Or in simple terms, we're saying the carrying value of this asset will be equal to 40,000 minus 35, which is equal to 5,000. Right, but the asset was sold for what? For 6,000. Right, so normally you make a profit when you sell the asset or the selling price of the asset is more than the carrying value. right? You make a profit. And what was the profit on sale? That's 6,000 minus 5,000, which is equal to 1,000. So that will be the profit on sale of that particular asset. So the profit is realized when you sell an asset or dispose of an asset at above the carrying value. And this particular profit on sale you find in the income statement, it will go under other operating incomes, right? It will go under other operating incomes, right? Then an example, there is an example here, right? Just a straightforward example. A business sold a vehicle for 60,000 cash on 31 August. So there was a sale of a vehicle for 60,000 cash on 31 August. Please pay attention to dates. The vehicle was bought on 3 years ago for 160,000, right? So the purchase price and accumulated depreciation on 1 March 2021, it was 96,000. Depreciation is charged at 20% on cost. Calculate if the business made the profit or loss on sale, right? There's one part that is missing here that I'll just say it now, right? The financial year for this business ends on 28 February, right? 2022. The financial year ends on 28 February 2022. That's the financial year end, right? So you have a vehicle. The cost price of the vehicle is 160,000, right? Accumulated depreciation at the beginning of the year is 96,000. Right, so if you are faced with this situation in the selling price, is 60,000. Right, so you see this accumulated depreciation is the opening balance. Right, so if you are given the opening balance of accumulated depreciation, right, and the vehicle was sold during the current financial year, it was sold on 31 August. Right, that means you need to calculate depreciation from 1 March to 31 August. Right, so you need to calculate depreciation for then. So depreciation, because it was said to be calculated 20% on cost, that's a straight line method. So what are we going to do? Simply we're going to say depreciation that will be 160,000. This will be on 31 August. Right, that will be 160 times 20% times that's March, April, May, June, July, August, 6/12, which will give you 16,000. Right, so to calculate the carrying value of the vehicle, right, at date of sale, it will be 160,000, that is the cost price, minus 96,000 plus 16,000, right, which will give you 160 minus 96 minus minus 16, which will give you 48,000. So this is our carrying value. Right. And the vehicle, right, if you are following, the vehicle sold at the selling price is 60,000. Right, carrying value 48,000. Right, that means there's profit on sale of 12,000. So as long as the whatever the asset was sold at a price that is more than the carrying value, you need to, that will be a profit. And just please make sure you pay attention that the account depreciation that you are given, is it the opening or the closing account depreciation, or is it the account depreciation at date of sale? Right, if you're given the opening at the beginning of the financial period, that means you need to calculate up to date of sale so that you can calculate correctly the carrying value at date of sale.